Good morning, good afternoon, good evening to you all. Welcome to this new webcast, Tax Talks, to talk about digital economy, or rather addressing the tax challenges of the digitalization of the economy. We welcome almost the whole team which has dealt with this topic is with me today to update you on the latest release of the OECD report, which occurred 1 hour ago, so that you would have time to scan through this report before our webcast. We're very happy to be able to explain to you what's in there, what's next. In particular, we will present this to the G20 in the coming days. I'm flying to Buenos Aires tonight, so we are just in the release of this report, which was approved a couple of days ago by the Inclusive Framework for BEPS implementation. I will now go through a short presentation before turning to the team. If you have questions, please send them. You have the address here. If you want to tweet, please feel free. And now a short introduction. First, I would like to bring us back to where we were in 2015, actually November 2015, when the Action 1 report was delivered to the G20 leaders, as well as all the other 14 reports of the BEPS Action Plan. What was concluded in this report was mainly four tiers. One, that we shouldn't talk about the digital economy, but about the digitalization of the economy. And this is significant. It's not only semantic. It means that the digital economy cannot be ring-fenced. It's pervasive, and the whole economy is digitalizing. And if there are tax challenges to that, they are for the whole economy. And that was the first main conclusion of this report. The second main conclusion was to say BEPS, because all this was about base erosion and profit shifting as Action 1 of the BEPS Action Plan, BEPS is probably exacerbated by the digitalization of the economy. But the report also said, well, maybe this BEPS issue will be addressed by the rest of the BEPS project, and there will be an exacerbation of the response through the BEPS measures. And it was agreed that we would take stock of BEPS implementation by 2020. The third element was about VAT. We focus a lot on corporate income tax, and sometimes we forget about the fact that in most countries, VAT represents a much higher share of the overall revenue than corporate income tax. And during the work on Action 1 report, we said, well, there is a need for further clarity as regards the tax treatments of e-services. Where are they to be taxed? And we came up with rules, with a set of rules based on destination principle, explaining how to collect the VAT. And this has been agreed by all BEPS Inclusive Framework members, and now is being implemented by more than 100 countries. Finally, on the core issue of where is corporate income tax to be paid, the report didn't come with an agreement. It explored different options, kind of, but was not conclusive. And this issue was left for further discussion, recognizing that there was something broader than BEPS at stake there, which was about how to allocate the rights to tax. So this is where we left it in October, November 2015, after the G20 leaders in Antalya took stock of this report. And we were mandated to deliver an update by 2020. What has happened more recently is that 1 year ago, I think it was on the 17th and 18th of March, the G20 Finance Ministers, under the leadership of Mr. Schäuble, the Finance Minister of Germany, decided to mandate the OECD with a report, an update report, an interim report to be delivered by the spring meetings of the IMF and the World Bank, which are to be planned in April 2018. So we had 1 year to do an interim report, and the communiqué highlighted the fact that this interim report were to be delivered by the Task Force on the Digital Economy. What is the Task Force on the Digital Economy? You have the acronym on the screen, TFDE. The Task Force on the Digital Economy is a subsidiary body of the Committee on Fiscal Affairs in its inclusive framework format. As you know, following BEPS, we established the inclusive framework. We now have 113 members on an equal footing. And this inclusive framework, which decides on the BEPS implementation, on the peer reviews, but also on the digitalization of the economy and its tax challenges, established, or kept actually, a task force on the digital economy where you have all these countries on an equal footing. And it's this task force which worked this report out and which has delivered it. And last important word, it's an interim report, as I indicated to you. It was planned to deliver something by 2020. But a number of countries, starting with Germany, but many others in Europe, France, Italy, Spain, outside of Europe, Israel enacted legislations. Indonesia has indicated its will to pass legislation. Many countries said, we are very concerned. We need to act faster. So because of that, it was agreed to deliver this interim report, that we would go faster and that we would describe where we are, what is at stake, and how to move the ball forward, and not only to remain with the disagreement which had been expressed in the Action 1 report as regards longer-term solutions. So, interim report to be delivered to the G20, and we did manage to get agreement a bit earlier than scheduled, as we will be able to bring this report to the G20 Finance Ministers, not in April, but in March. Now, what is in this report? This report that you can see, that I do have here, this report is made of 8 chapters, and mainly you will find there a very interesting long chapter which is based on the consensus of economists of what the features of the digitalization of the economy are, but with the perspective of the challenges on the international tax system. So you have an in-depth analysis of the business models, of value creation, and of new concepts. We'll go back to that later with Giorgia, but on scale without mass, heavier reliance on intangible property, intellectual property, as well as user contribution. Then we try to take stock of where we are on BEPS. And actually it looks like, even though we do not yet have all the data, but all countries have been implementing BEPS. There is already an impact. A number of companies indicated that they will put permanent establishment or subsidiaries, which will be taxable entities in a number of countries. Facebook did that in December. But there is also a very important piece in that landscape, which is the US tax reform, and in particular the guilty provision, which will provide for kind of a minimum tax of 13% on excess returns, which means that the single-digit effective tax rate for offshore activities is something which will come to an end, which maybe is already coming to an end. Then, drawing on this, we try to explore what we call long-term solutions could be. Let's be clear, long-term solutions doesn't mean that they will be adopted in the long term, in decades, but rather they could be adopted quicker than that, but they will be lasting much longer. They are for the long term, a revision of international tax rules. And we'll go back to the details there. And also, the report responds to the question raised by a number of countries on short-term measures that we call interim measures. Some countries are obviously and fiercely against these measures. You may have seen a few minutes ago that the US Treasury released a press communique indicating the position of Secretary Mnuchin, saying we strongly oppose this. We strongly oppose this. A number of countries and European countries in particular insist on they need to move. And you may have heard that the European Commission will table next week some proposals of directive which will include short-term measures. So clearly here, countries are divided, and the report describes what the positions are. Finally, there is a chapter on special features and in particular what else can be done. We talk a lot about corporate income tax, but there are very simple things like enhancing tax administration cooperation to get all the information and use it so that service providers or people using platforms would be taxed where they are to be taxed. And there are new challenges, cryptocurrencies, blockchain technologies and others. They are mentioned in the report as we collectively need to work on that. And finally, we explore the next steps. I will go quickly on what the main messages are because the team will detail each of the chapters and the key messages. But my takeaway, or what I will take away with me and the Secretary General to Buenos Aires in Argentina for the discussion among the G20 Finance Ministers, is one that there is a global agreement to work on this issue and to work fast on this issue. Now, it is true, and you will see that for the long-term solutions, the perspectives are different. But I think nowadays it's important and pretty reassuring, positive to see that in spite of tensions, which are rising here and there is a common will to work together on the global framework for taxation. From China to the US, with the European countries, developing countries, emerging economies, all agree that they need to keep together and to work on this with a commitment to seek a solution by 2020. So continue the work, which per se is some news. Second, the report will show that this is a complex issue. It's not a low-hanging fruit. It's not something which can be addressed overnight and it's because some people would drag their feet or some countries would drag their feet that the discussions at the OECD wouldn't have been conclusive, even though it's been a few years that we're working on that. Instead, I think this report shows the complexity. I know as a civil servant, as a technocrat, that complexity is very often used as an excuse to say we cannot do anything, we don't want to do anything. Here, it's rather the opposite. We need to look into the reality, into the complexity of the reality to be able to overcome this and to find solutions. And by identifying what countries' positions are to some fundamental questions, I think this is the way to solve the differences of perspectives which are indicated, revealed in this report. So complexity requires in-depth analysis done and now some hard work to solve the differences. Third element is that we identify what we would call buckets of countries. There are some countries which do things, and it will be no surprise that these are rather small open economies, that the rules are what they are, and after BEPS, they do work pretty well, and that there is no urgency to fix them. There is another bucket of countries saying, because of the new features, heavier reliance on IP, user contribution, scale without mass, there are pressures on the existing standards, and solutions should emerge from these different features, some putting the emphasis on user contribution. The third bucket, and you may read that through the press release issued by the United States of America earlier today, is there may be a broader issue. Digital is not per se something which would require a solution, but there may be a need for a solution for the broader picture. So you can see that you have different perspectives there. The report, and that's another key takeaway, discusses short-term measures, does not recommend short-term measures because there is no consensus for short-term measures. On the contrary, a number of countries are strongly opposed to short-term measures. And the report identifies what are the constraints for short-term measures or interim measures. Can you do anything? And if you are to do something, what are the constraints? Tax treaties, WTO rules, and so the report explores these and reports on the different perspectives there, including those of the countries in favor of introducing such measures. Finally, the report indicates that there is an expectation that something could be delivered by 2020, but we keep working. Next meeting of the task force will be in July 2018, in a few months, which will leave time to the OECD Secretariat to table a paper for countries only, for delegates only, food for thought, so that we can move the ball forward. Basically, we have a report. We encourage you all to read it. It's a pretty detailed report on business models, on value creation, on describing the country's position. It's an interim report. People shouldn't expect the magic solution out of this report, but it will pave the way towards long-term solutions to be adopted quite fast, we hope, if countries indeed implement their willingness to work together in spite of all the tensions that you can hear here and there. So this is the context, and now I will turn to the team to get to what has happened since the 2015 package. I think it's David who will take over from here.
Thanks very much, Pascal. It's great to join you all. And what I will do for the next few moments, very briefly, is to just walk through what we've achieved over the last year in order to demonstrate just how fast-paced the work has been undertaken. As Pascal indicated, at the conclusion of the BEPS project, when the BEPS package was handed down, there was a decision then to establish the inclusive framework on BEPS. And it was only in January of last year when the task force on the digital economy had its mandate refreshed. And really, it's been in just over a year that the work that is now being produced in this report, this interim report, has been conducted. Significantly, when the task force's mandate had been established just over a year ago, it was originally envisaged that there would be a final report in 2020, but that an interim report would be delivered before the end of 2018. Of course, we're a long way from the end of 2018, and indeed, as Pascal mentioned, in March of last year, the G20 Finance Ministers indicated that they had requested, in fact, that we would bring forward the delivery of that interim report so that it would be delivered by April 2018. So, in fact, delivering here in March, we are delivering this interim report ahead of schedule. In terms of the process that we've been through, there has been not only very considerable engagement with the 113 member countries and jurisdictions that form part of the inclusive framework on BEPS, but there has also been widespread public consultation, and that has involved contributions right across the spectrum: businesses, business groups, representative bodies, practitioners, civil society, and academia. There has been widespread contributions. We had a request for input in September last year, and we held a public consultation meeting at the University of California, Berkeley, on the 1st of November last year. And we had more than 100 people attend that particular consultation. We received more than 50 written submissions, and we have undertaken a series of bilateral and multilateral conversations with business groups and other bodies. All of that, and throughout this period, we've been meeting intensively with the various delegates of the task force on the digital economy, all on an equal footing, representing those 113 countries and jurisdictions. And that has allowed us to come forward today and to present a report, an interim report that has been produced by consensus. So that's it's been a rapid, fast-paced period, but now for some details of what's contained within the report, I'd like to hand over to Giorgia Maffini, who will take us through some of the work that's been done on business models.
Thank you very much, David. So I will take you through our work on business models and value creation, which is a very important part of the report. People talk a lot about the digitalized economy. We all have some experience in interacting with highly digitalized businesses, and we all know a little bit about their operations. The reality is that when we started preparing this report, we were really confronted with an enormous amount of complexity and heterogeneity across business models. You have, for example, a ride-for-hire company, which is very different from a cloud computing company, which again is very different from a music streaming service. And they're all, in fact, digital companies, digital businesses. So in this context, what Chapter 2 does is to start from this complexity and to boil it down to a manageable set of key characteristics of digitalized businesses. How did we get there? As David has just told you, we went through a very constructive set of consultations with businesses, which have provided us with a lot of insights into their operations, and we are very grateful for that. And of course, we have also looked at the most recent economic and management studies. So in this way, we have identified three main specificities of highly digitalized business models. The first one is cross-jurisdictional scale without mass. This means that often highly digitalized businesses deeply interact with the economic life of a jurisdiction without any need of a significant and physical presence. Highly digitalized businesses also heavily rely on intangible assets, and here you might say that this is something that is not new at all. We agree with that, but we think that it's the scale of the reliance on intangible assets that is completely new for some highly digitalized business models. The third characteristic relates to the heavy reliance on data and the importance of user participation. And on this last point, among the countries of the inclusive framework, there is general agreement that data and user participation are common characteristics of highly digitalized business models. But for the moment, there are differences in opinions on whether and the extent to which data and user participation contribute to value creation by the enterprise. We have a set of countries that sees the role of user participation as unique, as very important to value creation. Why is this? Because highly digitalized businesses, by using user participation, can collect a great deal of data, of information, and they can monetize on that. Clearly, if we ultimately decide that user participation is important, we will also need to think about how to allocate profit to user participation. And this is complex, and this reflects the complexity of our task, as Pascal has told you before. The second group of countries sees the action by highly digitalized businesses to source data from user as equivalent to sourcing inputs from an independent third party. Clearly, this implies that sourcing data is not an activity to which profit should be allocated or attributed. You can see that these two views of the world will have very different tax implications, very different implications for the tax system, and that's what we will be working on, and David, I think, will tell you a little bit more about this later on. And I think this is all for me. I'll pass you on to Eric, who will be discussing BEPS implementation and country measures. Thank you.
Thank you, Giorgia. So another important piece of work conducted by the task force has been related to monitoring. Monitoring BEPS implementation and its impact on the tax challenges raised by digitalization. Monitoring also other measures adopted by countries across the world that are potentially relevant to the work of the task force. Chapter 3 of the report deals with the BEPS implementation part of the monitoring activity. And here the work of the task force has focused on the measures in the BEPS package that were identified in the Action 1 report as particularly relevant to deal with the BEPS issues exacerbated by digitalization, namely the amended PE definition under Action 7, the revised transfer pricing guidelines under Action 8 and 10, the strengthened CFC rules under Action 3, and the proposed mechanism to improve VAT collection under Action 1. In addition, some other BEPS measures have been covered by this monitoring work to the extent that they were also considered relevant to digitalized businesses, such as the minimum standard on treaty abuse or the nexus approach for preferential regimes. Now, in terms of impact, thanks to a very comprehensive and widespread implementation of these key BEPS output, and Pascal referred earlier to the guilty in terms of CFC rules, for instance. Well, the report and chapter 3 contain some positive news as regards BEPS issues. Here, the task force has been able to gather some evidence that taxpayers are changing their behavior with a view to realign the location of their taxable income with the location of their real economic activities. This includes, for example, modifications of trade structures, such as conversions from remote sales models to local reseller models to serve a given market. This includes also relocation of valuable assets, such as intangible assets, into jurisdictions where substantial economic activities take place. Now, when we move from the BEPS issues to the broader direct tax challenges, the results of these assessments are less positive, because here we have a large number of countries that take the view that these broader tax challenges have remained to a large extent unaddressed. The reason for this is that the BEPS measures, including the amended P definition under Action 7, were designed to eliminate double non-taxation. They were not designed to deal with the broader tax challenges, which, as noted earlier by Pascal, chiefly relate to the allocation of taxing rights between countries. Now, the other part of the monitoring work is covered by Chapter 4, entitled Other Relevant Tax Policy Developments. Here, the objective of the work of the task force was to identify and analyze country measures that adopted across the world that go beyond the measures that were agreed in the BEPS package, but also respond to policy challenges that are relevant to the work of the task force. The task force has identified a number of measures that have been grouped into 4 categories that are listed on the screen. So you have alternative P thresholds, withholding taxes, turnover taxes, and specific regimes to deal with large M&As. Regarding the latter category, it should be noted that these measures are not specific or exclusive to digitalized businesses, but they have been covered by the task force to the extent that they were considered to be also relevant for highly digitalized M&As. So these regimes and their implementation have been studied thoroughly by the task force in close consultation with the relevant countries. And this has enabled to identify some interesting common features. The first one is the objective. These measures generally seek to protect or expand the tax base in the country where customers or users are located. Another interesting common feature is the technique. These measures generally use elements linked to a market to design their tax base, such as sales or other concepts such as place of consumption. Finally, more generally, there was agreement that these measures reflect a discontent among some countries with the outcome produced by the existing tax framework. So these are the main conclusions regarding Chapter 3 and Chapter 4. So we're now finished and we will move on to Chapter 5, and I will hand over the floor.
Thanks very much, Eric. And we've just heard from Eric there that whilst the BEPS implementation has been effective, and certainly early evidence indicates that, we have also recognised that there are broader tax challenges, those identified in the Action 1 report, that remain outstanding. And the work set out in Chapter 4, as Eric mentioned, around measures that countries have taken, to some extent reflects the fact that those issues remain outstanding. In Chapter 5, we deal with these broader questions, and we seek to work towards finding what those solutions might be. The chapter begins with a consideration of some of the key and fundamental rules of the international tax system, in particular the nexus and the profit allocation rules. The nexus rules are those rules that determine jurisdiction to tax a non-resident enterprise, and the profit allocation rules are those rules that determine the relevant share of the profit that will be subjected to taxation. Now, in undertaking that assessment, we then consider and reflect upon what the potential implications of the changes that are being observed as a result of digitalisation may have on the international tax system. And this is where we go back to the work that Giorgia just presented in relation to these features that are frequently observed in relation to highly digitalised businesses: cross-jurisdictional scale without mass, reliance on intangible assets, and data and user participation. The interim report looks at these considerations and reflects upon what may be some of the implications for the international tax system of these features and their existence within highly digitalised businesses. And what we see is that cross-jurisdictional scale without mass is already impacting the distribution of taxing rights and will continue to do so over time by reducing the number of jurisdictions where a taxing right can be asserted over the business profits of a multinational enterprise. We see that in relation to intangible assets and the reliance on them, that even though there has been significant progress made as part of the BEPS project, it is the case that it is often difficult to determine how to allocate income from intangibles among the various parts of a multinational group. And there, in that sense, may well be challenges faced by the international tax rules as a result of this particular feature. In relation to data and user participation, and as Giorgia said, this is an area where there is still some contention amongst countries. If data and user participation are considered to be a source of value creation, then clearly that would pose challenges for the international tax framework, because the concept of value creation does not currently take these notions of data and user participation into account. So if you are to accept that view, then that, as Giorgia indicated, would clearly have implications for your view as to whether or not there are changes necessary to the international tax framework. As Pascal mentioned at the outset, there are a range of views, and whilst we've sought to come up with some groupings, some 3 groupings of where we think countries generally fall within, it should be said that these groups, there are differences even within the groups, but I think it is very useful, and certainly the Task Force on the Digital Economy believed that it was a useful way to present the various perspectives of countries. And the first group is a group that believe that user participation is unique. It's a unique consideration experienced in the digitalisation context. They also believe that this has led to a misalignment between where profits are taxed and where value is created. And most of the countries in this group do not believe that this gives rise to any fundamental questioning of the principles of the existing system, but generally they see this as being the basis upon which targeted changes to the international framework may be required. We have a second group, and the second group believe that digitalisation and globalisation more broadly of the economy present challenges to the existing framework. Most importantly, this group take the view that these challenges are not in any way exclusive or specific to highly digitalised business models. And the consequence of taking that view is that any changes that are to be made to the international tax framework would have to apply more broadly to the economy. And then there is a third group, and the third group of countries take the view that by and large the BEPS package has addressed the key issues relating to double non-taxation. They would say that it's still too early to fully assess the impact of the BEPS package, but notwithstanding that, they are generally satisfied with the existing system, at least at this point in time. So you see there across the 113 member jurisdictions, there are a range of views, there are divergent positions. Clearly, we do not underestimate the challenges associated with trying to reconcile those divergences as we move forward. But equally, I think all members of the inclusive framework share the view that this has been a critical first step as we move forward in recognising what the different country positions. We have had countries reflect upon the key questions that are at stake and better understand and better articulate their positions, and this will be the basis upon which we will move forward. In terms of where we will go moving forward from here, I mentioned a few moments ago there are clear points of divergence, but there are some areas where there is strong agreement. And there is certainly agreement amongst members of the inclusive framework to undertake a coherent and concurrent review of the profit allocation and nexus rules that would consider the impacts of digitalisation on the economy relating to the principle of aligning profits with underlying economic activities and value creation. And I think importantly, countries really have demonstrated a willingness to work towards a consensus-based solution by 2020. As I indicated a few moments ago, we do not underestimate the nature of that challenge, but we think that this report provides a very important basis upon which we can progress that work, working closely with member countries of the inclusive framework. And as we move towards 2020, we will provide an update in 2019. I will now hand over to Achim, who will speak to the chapter on interim measures.
Thank you, David. Yes, we're moving from the long term to the short term to the interim. I get to speak, so you'll have 2 easy slides that tell you everything you need to know on interim measures. First, what are interim measures? They may be taxes on the supply of certain e-services, digital taxes, different words are being thrown out. We understand also that the EU package to be announced will have one of these interim measures as part of the package. The headline messages here in our report, I think essentially they're summarized in the slides. So there is no consensus on the need for or the merit of an interim measure, and logically as a consequence of this, the report does not recommend the introduction of such a measure. So that's the headline message, I guess, around interim measures. And then a little easier compared to the situation on the long term, essentially you don't have 3 groups of countries, but you have 2 groups of countries, the left-hand side on the right-hand side, and this is also all in the report, and it gives you a little bit of the senses. What are the points being made by those that are against interim measures, irrespective of their design? And then what are the points being made in the arguments advanced by those that are in favor of interim measures? And just running through this in the little time that we have, there's a couple of points, and of course there's more detail in the report itself. So those that are opposed to interim measures suggest that there is a lack of conceptual basis, as Giorgia has indicated and David as well. They do not think that user participation is a basis when translated into text terms on which any interim measure should be based, and they would also not agree to have a tax specific to digital or part of digital only. And they point out that in their view there is a potential for adverse consequences. And so what do they cite? Impact of a gross tax on investment, innovation and welfare. They say that if you tax digital, you'll probably have less innovation in digital, and that's not what you want to achieve. It is also importantly typically referred to as a tax on a gross amount, not on a net amount, which may have unpredictable consequences depending on the profitability, the situation, startup and otherwise, of the supplier of the service. They also point out that the incidence of taxation may, depending on the market situation and the composition, not necessarily be on the supplier, it may be on the user. It may be on SMEs, it may be on individuals. There's a possibility of overtaxation, they say, because also given that it cannot be an income tax, because otherwise there is a violation of the treaty, there probably isn't going to be a credit against corporate income tax or personal income tax, as the case might be, and there's an issue of potentially cascading. where a supply is integrated in another supply, and then maybe the tax would need to be applied and imposed at several stages of the supply chain. There's also a concern that an interim measure may prove to be something other than interim. And I guess there is history, and the history of taxation suggests that there have been taxes that commenced as interim, but they're still around with us. And lastly, they point out that there is compliance and administrative costs of bringing in a new set of rules with administrative procedures, if, in particular, the intention is to have this as an interim measure. But then flipping to the other side of those are in favor, they acknowledge that there may be some challenges, but there's a political imperative to act pending a global solution. There is, they argue, value being created in the country. There is user participation, mass without scale and intangibles. And so the value is being generated in their jurisdictions, but they're not taxing what they should be entitled to tax. And that situation, the status quo, does undermine the fairness, the sustainability, the public acceptability of the system as a whole. So this is a challenge that then needs to be weighed against the consequences of not acting. And also they point out that we've been discussing for some time already the global solution. Global solutions need to be agreed, they need to be developed, and then they also be implemented. And then last, they point out that some potential adverse consequences can also be addressed through the design of a particular measure. And that takes me to the second slide, which is now something that the countries that are in favor of the introduction of temporary interim measures, that those countries have nevertheless agreed that there should be guidance that they should collectively take into account when they move forward, in order to avoid a proliferation of very, very different measures where all agree that they would not be desirable. And so we now in the report have a part in the short-term chapter that goes through design principles developed by those in favor of interim measures that they wish to take into account as they proceed to the potential development of interim measures. What are those? And that's the last couple of points here on the slides. As you can see, first of all, it's important that there is compliance with a country's international obligations, in particular tax treaties, WTO obligations, but also for those that are members of the European Union, for instance. What does that mean? That means, for instance, that the tax, whatever the tax might be, the tax cannot be an income tax. If it was an income tax, you'd be violating your treaties if you applied them on known residents in the absence of a permanent establishment. So second, of course, within the EU, there's the freedoms that need to be respected, the non-discrimination, and that probably suggests that it needs to be imposed on residents and non-residents. And there's the other aspects, and all of those we explain in the chapter. Second, there's an agreement that this measure needs to be temporary. It is meant to come with a label of a clear policy intent that it is meant to be temporary, that it is not meant to undermine or be an obstacle towards the agreement which is desired, as David has said, by all, of a global solution. Third, it needs to be targeted. And there we're quite specific that those countries wishing to proceed all agree that it shouldn't be imposed on the delivery of goods, even if the contract was concluded online. They also further agree that it shouldn't be on a broad range of e-services, but it has to be specific services to avoid anomalies and to avoid bringing in situations where there is low user contribution, which may otherwise be the case, and where we might have situation that the sale of the book is not covered, but the sale of the e-book is, the sale of the disc is not covered, but the streaming of the music is, to avoid all of these situations that would be anomalies and difficult to explain. That then brings those countries in favor of interim measures to a discussion around internet advertising and online intermediation services. There's a discussion of this, and the complexity is certainly higher in the intermediation services, as you will see when you read the report. Principle number 4, minimizing overtaxation. There's challenges. One that I've already explained, it cannot be an income tax, otherwise it probably violates treaties to the extent it's imposed on a non-resident without a permanent establishment. That means it is an additional tax and cannot be credited. And there's also the issue of cascading, which I have also explained. So trying to minimize that, and of course it also goes to the rate that might be set in any measure that is imposed on the gross amount. Principle number 5, minimizing the impact on startups, business creation, small business needs to be out for reasons of complexity, cost, and of course also profitability, especially in the digital sector, where this may be coming in a later stage of creation. I think that's an important principle that these countries have given themselves. And then finally, minimizing cost and complexity, relying perhaps to the extent possible on the existing VAT infrastructure as a conceptual basis, and also importantly having common rules on the place of supply, because this is digital platforms with nexus in many places, and you wouldn't want to have an interim measure that then gave basis to taxation, not just 1 or 2 or 3, but even more countries. So we'll also discuss in the report quite specifically the details around the place of supply and the related challenges. So that, in a nutshell, I think is it on the interim measures, both with respect to those that want them, that don't want them, and the principle that the latter group has given itself. And with that, I give it back to Caroline and the special feature.
Thank you very much, Achim. Thank you, Pascal. Very good to be here today. And I'm going to shift gears a little bit to talk. A lot of the report is dedicated to looking at how digitalisation may be impacting the international tax rules. But there is a special feature in Chapter 7 of the report, which goes beyond the international tax rules to look at some of the implications for other parts of the tax system. Moving forward with the slides there that you'll see on the screen. So one of the important first areas that the report looks at in Chapter 7 is the rise of the gig and sharing economies, and in particular how that's being facilitated by online multi-sided platforms. We see that these platforms are encouraging economic activity, driving growth, and that they also can have the potential to shift some activities from the informal economy to the formal economy. But there are also important tax implications that result from these changes. So first of all, we see the rise of what we call non-standard work. In particular, you see, for example, the shift from employee status to either self-employment or to incorporated businesses. And with that comes obviously tax implications, both for individual taxpayers, but also for the tax system as a whole, as we start to see that trend really increase. That can have important implications for revenues, also for social security contributions, and we're undertaking some work at the moment to look at what the long-term trends might be in that regard. Secondly, an important aspect when we see the rise of the gig and sharing economies is to consider the effective taxation of these activities. In particular, when we have peer-to-peer transactions, we see taxpayers often have uncertainty about what sort of tax liabilities arise as a result of their activities online through these platforms. So there are a couple of ways that we have identified, in particular in the Forum on Tax Administration, to address this issue. First, of course, is through improved taxpayer education to enhance self-reporting, but also a piece of work which is underway now, looking at how tax administrations can work with these online platforms in order to be able to access the relevant information and improve the ability of taxpayers to more easily meet their tax liabilities. Now, this really needs to be an international effort. We know on the online world you will often have two parties transacting who are in different jurisdictions. You may also have the data about those transactions being held by the platform in a third jurisdiction. So it's really important, in order to be effective, that we look at this as a cross-border issue where tax administrations can really enhance cooperation. One of the other important areas that we see identified in this special feature is the impact of digitalisation on tax compliance. And there's a couple of issues identified here. For example, we're seeing how big data combined with behavioural science can actually have some very strong outcomes in improving tax compliance. Now, that's both in terms of improving taxpayer services through better online services, but also, for example, the pre-filling of data, particularly, for example, when you see, combined with this rise of non-standard work, you may no longer have as many people in the pay-as-you-earn system that you often have in place in many countries. So using big data combined with new technologies, we can see how we can actually reduce the compliance burden for taxpayers. We're also beginning to see how we can use this information to improve audit targeting through better risk identification, and that's something where tax administrations are really starting to invest in new technologies, and you have some very nice examples in the report of how they're doing that. Finally, I'll just mention before passing back to Pascal, is that obviously there's a lot of opportunities, new tools that we're seeing as a result of digitalisation in this area. There are also some risks. Pascal mentioned in his opening blockchain distributed ledger technologies, and those we are seeing potentially have the possibility that they will undermine some of the advances that we've made in tax transparency over the last decade, particularly when we see them manifest in cryptocurrencies is just one example. So we have both the Forum on Tax Administration and also the Task Force on Tax and Crime starting to look into these issues. And so the report identifies in Chapter 7, special feature, not just the work that we already have undergoing in these areas, but also the future work program that we're going to take forward to make sure that tax administrations and also policymakers really stay at the forefront of these developments. Pascal.
Thank you, Caroline. We'll move to the next step. Actually, I've already described to you what's going to happen next. We will have immediately for us a meeting of the Task Force on the Digital Economy to discuss some of the elements of the special features, to also start working hard on the solutions, and the Secretariat will initiate that work, but this is intergovernmental discussion this time being, and we do not know when there will be papers for public consultation, so you can spend a nice summer, whether there is a break or not. There will be no requests for public consultation or inputs in our process. Second, we will do this work with the view of delivering a report in 2020. You know that at the OECD we do deliver reports, but we don't necessarily like delivering just reports. We like delivering changes, but that will depend on the positions of the countries, and the hard work ahead of us is to reduce the differences, to bridge the gaps between the different bucket of countries that we have described, and to try to see whether we can advance in this area. The work which will be done will be based on exploring further what these different perspectives are. Again, I think we've done the very hard analytical work. We now are in a position to start exploring what the consequences would be of the different positions, and we will see whether we can make progress rather than just saying countries are not in agreement, which is not necessarily the most helpful thing in terms of moving the ball forward. There will be a monitoring of what's happening, a monitoring of BEPS. You will remember that everything started with BEPS, with elimination of double non-taxation. So we need to see what's the impact of that. I know that many people have turned the page and consider that it is almost done. It is not. We have implementation work. We need to measure the impact of this implementation on business structurings, on tax planning, and on the way tax administrations can work and implement tax legislation. So there is work, monitoring work, which is important. And even though the elimination of double non-taxation, we think, is on its way, it will not solve the broader tax challenges as have been highlighted during this webinar. Finally, we will have to explore the special features that Caroline mentioned. And this work will be shared between the different working parties at the OECD, depending on the specificities. For the time being, the task force remains. We'll carry out the work. We'll probably do coordination. And then when we get more specific and when it is about nexus, would probably be at some point working party one to have a mandate to work on this, or profit allocation working party 6, or we'll revise the organization. But for the tax geeks who are watching us, and you have to be a tax geek to watch a webcast on tax on a Friday afternoon, morning or evening, you know that we are equipped with many different groups to deal with technical matters, and this will be, of course, incorporated in our thinking on how we move this forward. Immediately, I think that the next step for you is to read the report. We have not received many questions, actually hardly any one on the EU. We'll come back to this in a minute, so we may even finish a bit earlier than planned because of the lack of questions, but maybe you don't have questions because you're all eager, anxious to read the report, so we'll leave you read the report, and no doubt you will comment on this. The tax Twitter tax will be active on that, and you will also monitor what happens at the G20 Finance Ministers meeting, which will deliver its communiqué on Tuesday afternoon, Argentina time, and you will also look into the details of what the European Union will release, even though it sounds or it looks like there have been some leaks there. I think we've done, on our side, a pretty good work at not leaking, which means that you are now eager to read the report that you could not have access to earlier. Now, a word to respond to the question we have received on will this report prevent the European Union from moving? The answer obviously is no. Countries are sovereign. The European Union is, has its own complexity. It's the member countries which are sovereign, but they may decide to act together based on proposals by the Commission. So what is going to be tabled are proposals by the Commission. We understand from the exchanges we've had with the Commission that there will be a directive on short-term measures or interim measures, which will probably reflect what countries in favor of introducing such measures have included in our report, on the one hand. And will this happen in the European Union? That's a question for the European Union, and whether some unanimity can be reached or not, which is not our field. As regards long-term measures, we understand that the European Union will also come with a draft directive in the context of the CCCTB draft directive, which is still on the table, together with a recommendation for the relationship between EU members and non-members, as this is a work of tax treaties which still belong to the sovereignty of member countries. So the European Union, we understand, will bring some food for thought, but this is food for thought for the broader discussion at the global level, at the OECD level. This is what we heard this morning from Commissioner Moscovici, indicating that in his approach there is the global level, and that's at the OECD. He may want to contribute some ideas, which I think the Commission will do, but that's the next 2 years which will keep us busy on that field. We invite you to reflect on this, to comment on this. We will remain engaged with business. We will remain engaged with civil society to get their views, as we did in the past and as we did on this report, as we had a public consultation. We do hope that there will be constructive engagement. It looks like there is still a lot of political interest in that work, and there is, and that will be my last word, a real interest of governments, of the G20 and beyond the G20, of this inclusive framework for BEPS implementation, to work seeking long-term solutions, not necessarily in a decade, but as quickly as possible, by working on the differences of countries to try to reduce them and bridge the gaps. That's what the OECD is at the end of the day. We would like to be the adult in the room and helping countries to work together and facilitate international agreement for a solid multilateral framework which will eliminate double non-taxation and eliminate double taxation. We thank you all very much. I would like to thank the team which has done a tremendous work by achieving this report ahead of schedule. Thank you very much for having listened to us today, and we look forward to the next webcast which will come in a few weeks. Thank you very much.